What's up guys, welcome back to GTech Finance. So as usual for a daily video, let's talk about something serious, something that no investor wants to think about, something that's happened in the past but many people feel is going to happen again in the future. And no, I'm not talking about getting insane ROIs in 2020 because that's basically like getting free money. Instead, I'm talking about the warning of the lost decade. And no, I'm not referring to the lost decade is a term that refers to a 10-year time span where the stock market literally does not go up. And some investors are beginning to warn that the lost decade is going to start happening right now as valuations have skyrocketed way past their historic averages. For example, the billionaire Ray Dalio has been warning about a lost decade in the stock market as performance eventually slows down. Blackstone Capital Management says the same thing as investors are getting them ahead of themselves. Warren Buffett's partner Charlie Munger is bracing people for low returns. Michael Burry says the stock market is dancing on a knife's edge. And the most shocking from all is that a Tennessee man left $5 million to his dog because she's a good girl, but more on that later. Anyway, given the seriousness around potentially losing a decade's worth of momentum if the stock market were to slow down, I think it's still worth taking their warnings into consideration and discussing exactly what's going on, what might cause this to happen, the chances of it actually happening, and then the most importantly, what you could actually do about it to come out ahead profitable. But really quick, before we begin, I got a quick challenge for you. If this video gets 15 likes within the first 5 days, I don't know what I'm gonna do. I'm gonna upload 5 videos in one day. So I'll leave it to you. Just promise me that you can do it and I'll do the 5 videos on my own. So thank you guys so much, and let's get right into it. So if you want to see what the lost decade is and why so many investors are warning us about it, like I mentioned, on the surface, the lost decade is just a period of time where the stock market remains entirely flat or even loses money over a 10-year time span. Now, even though this might sound unusual or out of the ordinary, it's not impossible. And the fact is, it's happened before, past a few years. The originally lost decade was coined from Japan's economic crisis, where the stock soared in value throughout the 1980s before entering a period of complete economic disaster, deflation causing the markets to drop substantially, and now 3 decades later, the stock market has still yet to recover from it. This is to the same prices that was trading back in the 80s. For Japan, this was caused by low interest rates, which fueled speculation throughout the stock and real estate market in the 1980s, driving prices way beyond their fundamentals and into 100. This is a bubble territory in the fact the government became so worried about it that, so that they raised interest to prevent prices from rising any higher, and very soon after that collapsed values. The market started to drop 60%. Now, obviously, to respond to higher interest and lower prices, investors began hoarding all of their cash, which led to lower consumer demand and further lowered prices. That created a vicious cycle in which the lower prices dropped, the more cash people held onto, and the more cash people held onto, the lower prices dropped. And that was just a downward spiral. From there, the result is a Japanese stock market collapse that is lower today than it was 30 years ago. And the concern now is that the United States could see something similar, and the lost decade is not impossible from happening. For example, the S&P 500 was the same price in 1954 as it was at the peak of 1929. The stock market was also higher in 1968 than in 1978. And if you invested in 1978 and 1999, it took you over 10 years for prices to reach the same level after the dot-com crash. So as you can see, the last decade isn't entirely out of the ordinary, but it's not like it hasn't happened before. Now, some of the biggest investors are warning us that this could happen again over the next 10 years. So let's get a look into this further and now see what experts have to say. So the first billionaire, Ray Dalio, warned about the last decade in the stock market, and his reasoning is fairly easy to understand. He says that consumer demand is going to slow down due to the pandemic. That's going to lead to lower corporate profits, and some companies won't be able to survive that. That's going to cause slower growth, and over the next decade, the stock market could remain flat. The second we got was Blackstone Capital Management. The vice chairman said that stocks are overly valued and it might take us an entire decade to catch up where stocks are currently trading at. He also said that valuations are supported by record low interest set by the Feds, and as soon as rates start going up, that increases the cost of debt, which eats away the profits, thereby lowering the stock market. He also acknowledges that the Fed's move to save the economy was unprecedented, but that may push us towards lower than usual returns from here on out. The third we have One of the investors that I most respect, that would be Charlie Munger. He's the vice chairman of Berkshire Hathaway, and overall, personally, I respect his investment philosophy. So he's not a doom and gloomer. He's also not irrationally exuberant about the market either. Instead, he's practical, logical, and a realist. So when he says something like this, I think it's worth listening. He says that stocks and bonds are in a bubble due to Federal Reserve artificially keeping rates really low, combined with an excessive amount of new money, combined with an excessive enthusiasm for investing, which causing the perfect storm for prices to rise beyond where they should be. GameStop, Dogecoin. Okay. So the kind of money the government is printing now, a very extended period of time, we're very near the edge of playing with fire. His warning is that the stock market may now see lower than average returns simply because we've already gone up so much so quickly, and that is something worth preparing for. And finally, we got Michael Burry. You might know him from such hits as short Tesla stock that could plummet by 90, but today he has a different warning. He says that rampant speculation and widespread betting with borrowed money have driven the stock market to the brink of collapse. And then he also follows that up with saying, people say, I didn't warn the last time, I did, but no one listened. So I warned this time and still no one listens, but I will have proof I wasn't. So now, and all that out of the way, let's go and talk about how likely this is going to happen, whether or not this is really something to be worried about, and if it does, what you could do about it. But before we go into that, I got to tell you about something else that I worry about all the time, and that would be for you to hit the like button and subscribe to the channel. Okay, that was really terribly stuck in. But okay, so let's continue. Just let me check where I wrote it. Okay, where I wrote it. So all right, so first things first, how likely is the last decade to actually happen? Now, if we go based on what the experts say, we might actually be worse off. Take Ray Dalio, for example, in 2021. He called for a market bubble. In 2020, he said we're heading for a Great Depression. In 2019, he said the next crash is coming. And then right before there actually was a market crash, he said that he did not see a market or economic crash on the horizon. But in 2018, he warned that light is flickering. In 2017, he said the magnitude of the next crash would be epic. In 2015, he said it reminds him of the 1937 market crash, and that continues. Same thing also applies with Michael Burry. In 2017, he predicted an imminent stock market crash. In 2019, he called passive investing a bubble. In 2020, at the bottom of the market, he warned about a selling stampede. And of course, you know what, I'm going to go even further. In 2019, Blackstone warned about the mother of all bubbles. Not to mention, in 2017, the Blackstone CEO threw himself the party of the century for the low cost of $10 million. Complete, of course, with Gwen Stefani and camels. Yes, you heard that correctly. Gwen Stefani is the title, as with camels. For reference, he's worth $22 billion so $10 million for him is peanuts. It's the equivalent of spending $45 on a party for someone who's worth $100,000. I know this whole thing is crazy, but don't worry. Charlie Munger has actually been pretty consistent with his concerns, and that brings a lot of validity to the times where he actually does say something in 2019. Right before the illness, he warned about being afraid when democracy thinks it could print money to solve all of its problems, but given a time during which everything has gone up so much, he warns us that expecting that to continue is probably not going to happen. Now, in terms of what to do about this and where we go from here, here's my best and honest, unbiased opinion. So I don't want to sell you anything on this. It has nothing to gain from whether you listen to this information or not. Besides, if of course you hit the like button, subscribe to the channel, you know that already. So to have a last decade with the stock market is trading at the same price 10 years from now as it is today, it's likely not going to be the same price for the entire time. It's not like the S&P 500 is going to go up 1%, down 1%, then back up, then back down, then yeah. So that has never happened before in history, and most likely instead there are going to be lots of ups and downs. It's also highly unrealistic that you're going to make one single investment at the point in time, and then that's it for the next decade. And sure, I'll admit it, if you just did that, you will probably lose a lot of money. But again, most likely investing is going to be something that you do consistently, month by month and year over year, and that is how you can make sure that you will be profitable. So here's what I mean. I've shown this before, but it's especially relevant today and really puts us into perspective in terms of how much money you could make. So Spencer analyzed the returns of the stock market from 1980 through today and came up with 3 different situations. And Andre Jack mentioned them once a few months ago on one of his videos about the stock market collapse. And now, if you know Graham Stephan, which I think if you do follow me, obviously you know him because he's the man when it comes to finance. And so it's the very good example of Tiffany and the two others. I'll see their name right now. It was Tiffany, Brittany, and someone else. So Brittany, sorry. So Tiffany did really bad timing. So she invested all of their money every single time at the market peak. The second person, Brittany, invested all of their money every single time right after a market crash, timed it perfectly. But the third person just invested slow and steady, consistently month over month. Now you could assume, and you would assume, that the person who had the best market timing, which was Brittany, who literally timed it at every single bottom, ended up making the most money out of it, right? Wrong. It's the investor. Now, the investor who did the worst timing but invested every month $200, and for a span of 30 years, of course, from 40 years actually, from 1980 through today, turned her $200 a month with a 3% interest, because let's say it's that return, into $663,000 and $594. Now, the second investor, the best timing, who bought in precisely at the bottom of every single market crash, turned her $96,000 into $956,000. But the investor who put $200 into the market consistently every single month, regardless of where it was, turned that $96,000 into $1,386,000, simply because she invested as soon as she had the money available, without trying to time the market. Now, if you want a practical example of what would happen during the last decade, let's go and take a look at the years 2000 through 2012. So even though you made 4.66% total return throughout 12 years, if you include the dividends, your return skyrockets to 32%. But if you invested month over month, regardless of where we were in the last decade, your cumulative return jumps to 24.20%. With dividends reinvested, your return is as high as 42.35%. Now, of course, sure, averaging a 3.5% return annually is not all that mind-blowing, but it's still, for the last decade, that's not exactly bad either. And over an even longer time period, your returns just grow substantially from there. That's why if we do see a lost decade, it's really only lost for the people who just invest once and then never again. But if you're a consistent investor, then you should be okay. Of course, you see a lot of highs and lows in the S&P 500. It's going to be occasions to make even more money and even more money. So what's worth, I tend to agree with Charlie Munger. We should not get used to the types of returns we were currently seeing in 2020. These were absolutely wild, continue going higher, but historically it's a lot higher than average. There's a lot of excitement around investing right now, and it's yet to be seen if this will continue. My strategy to advise you would be to just invest consistently. So I think that's it for today. If you enjoyed the video, hit the like button, subscribe to the channel if you haven't already, and hope to see you guys next time.